and my audio is not coming through. Not sure if I have audio. Let me know in the comments if you guys can see me because I did not hear my intro music play. But we're going to go anyway. Today is Inflation Day. We are just moments away from the CPI, the Consumer Price Index for the month of April. It is due out at 8:30 a.m. Eastern Time, just a couple minutes right now. The market is forecasting 5% headline year-over-year inflation, which would be right in line with what we got last month. Also predicting 0.4% inflation month over month. This is coming after last month's reading, the reading for March, which came in at 5% year over year and 0.1% month over month. The real question here is how sticky will core inflation be? Sticky inflation, that's a phrase we've heard a lot about in recent months. That is the worry that people just kind of get used to higher prices and therefore prices just keep going up because, well, people are used to those higher prices. And so those people who are selling or people doing business just keep raising their prices. People are used to dealing with it, so people continue to pay. Well, how sticky will that be? We're going to find out today because inflation has been coming down pretty fast these last few months. We hit a peak last summer of around 9.1% inflation. And well, last month at 5%, obviously coming in very rapidly. The question is, does it keep going? A lot of people are saying we're going to pause here or we're going to, get stuck around this 4.5%, 5% area. My best guess is we are going to come in just below that 5% number. I have a couple of ideas why, namely energy, the base effect, and used vehicles. All right, those are some of the big ones. Now, keep in mind the base effect. We're talking about a year-over-year number. So we're going to compare the April number to April of last year's number. Just like last March or last month, we compared the March of 23 number to the March of 22 number. Well, keep in mind, we're coming up against the point where inflation really started to peak between March and May. March and June of last year was really when those energy prices shot up and went crazy, especially, with the Russian invasion of Ukraine and the initial reaction and then the subsequent dumping of the Strategic Petroleum Reserve, which began around May, June timeframe of last year. That quickly brought energy prices down. So the base effect is really going to start playing a role here. And, well, let's just shrink my melon of a head and take a look at some of these things. First of all, what you're looking at right now, this is bls.gov/CPI. This is where it's going to be posted in just over 2 minutes right now. And you can see right here, this is last month's CPI. I'm going to zoom in a little bit. Here's the 5% headline number that came in last month. Here's the 0.1% for March. Now, a couple of the big ones here. Obviously, energy was a big factor. The energy index came in at negative 6.4% last month. And I think we're going to see another big negative year-over-year number this time around because the number we're comparing to a year ago is also going up still. And so even though energy prices didn't move all that much in the month of April, the number we're comparing it to came up. And so we're looking at a smaller increase. The other things we want to keep an eye on here, check out used cars and trucks. A negative 11.2% year over year last month. Used cars have just absolutely plummeted in prices. Again, we're talking about the rate of change here. That's important, right? Rate of change. You can see a lower CPI print, that still means prices are going up. It's a negative print, means prices are going down. So even if the number comes down, that could still mean prices are still going up. And right here, this is the Manheim Used Vehicle Value Index, and you can see that 11% decline that we saw last month. Now, this is the number that's being paid by car wholesalers. This is what the cars are going for at auction. So there's a little bit of a lag. It takes a little while for these numbers to show up in the CPI print. But I think that will be another big factor today is going to be used car prices. So real quick, we are now less than a minute away from the CPI number. I'm going to keep refreshing our numbers here until we see the April number appear. Let us know in the comments, where do you think this number comes in? I'm going at 4.8. I think energy is going to bring us down. I think used and new vehicles are going to bring us down. But I also think the shelter index is going to continue dragging higher. So overall, I think we're looking at a 4.8% headline number, but that's not released yet. That's just my guess. We're still waiting on the number to be posted right now. I'm going to be refreshing here. Also, keep in mind the Federal Reserve is a big factor here. Oh, there we go. CPI for all items rises 0.4% in April Shelter, used cars and trucks and gasoline were up. Interesting. Used cars were up. So much for my theory. And it looks like the headline year over year number is 4.9%. I was off by just a little bit. Hold on. Let's see what's going on here. It seems like the link does not want to load. Bear with me, folks, while it's loading here. Well, while that chart is loading, let's see. Okay, we have got right now the Dow futures are surging up 82 points. Look at that big green candle forming right now as we speak. It seems the market likes this report right now. S&P is surging, but, well, not surging, up about 14 points right now, and the NASDAQ up almost 60 points at the moment. So right now, stocks really liking this report, and I just cannot get the report to load. This is where Gigi comes in and says, stop clicking on things and just let it load. Sorry, I can't do it. I just can't leave it alone. Seems the BLS website is, well, they're a little busy right now. Well, this is kind of blowing up my stream, isn't it? Thanks, BLS website. Jeez. You know, all your tax dollars are work. Here we go. The Consumer Price Index for all urban consumers rose 0.4% in April on a seasonally adjusted basis after increasing 0.1% in March. Over the last 12 months, the all items index increased 4.9% before seasonal adjustment. So there you go. There's your headline number, 4.9%. I think that 4 handle is all the market is going to see, and the market's going to like that. The index for shelter was the largest contributor to the monthly all items increase, followed by the index for used cars and trucks and the index for gasoline. The increase in the gasoline index more than offset declines in the other energy component indexes, and the energy index rose 0.6% in April. The food index was unchanged in April as it was in March, and the index for food at home fell 0.2% over the month, while the index for food away from home rose 0.4%. All right, let's take a look at some of the numbers. Here we go. There's your 4.9% headline number and your 0.4% month-over-month number. Food at home came in 7.7% year over year. That's a lower number than we've seen in some of the previous months. And there you go. You can see 2 consecutive flat month-over-month readings from food at home. So at least the average working class person is getting a little bit of a break. And when I say a little bit of a break, I mean he's just not getting clubbed over the head repeatedly anymore. They stopped clubbing him. It still hurts from the prior clubbings. But at least this is showing that food at home, which is basically the cost at the grocery store, has stopped going up according to CPI for the last 2 months. Food away from home came in at 7.1%. That's your restaurant meals. The energy index is still negative at negative 5.1, although that is less negative than it was last month. So that's an overall addition to the index, with the month-over-month number coming in at 0.6. Now, looking at some of the big changes here, it looks like gasoline, these are year-over-year numbers. We had energy commodities down 12.6, gasoline down 12.2, fuel oil down 20.2. So still big negative numbers in the energy commodities. Let's see, what other big numbers do we have here? Your core numbers, core inflation at 5.5 and 0.4. So that is down ever so slightly. Last month, we also had 0.4 month over month for core inflation, but we had 5.6% core inflation last month. So a very, very slight tick down in the core inflation numbers. I don't think that's going to be enough to inspire relief among markets, but at the very least, core inflation is not trending up still. So we'll take that as a good sign, but just barely. So core inflation still a little bit sticky. Now, here's the one that shocked me a little bit is the vehicle numbers. New vehicles comes in 5.4% year over year with a slightly negative number. So the price of new vehicles starting to come down according to CPI. Now, that's not what I've read in some of the other media, although some of the media, when you see average car prices or the price paid for a new car, that's being skewed a little bit because a lot of the headlines you see in the media don't mention that luxury cars now make up a higher percentage of the new car purchases that are out there. Basically the average person, middle class, poor working stiff, can't afford a new car anymore. And so there's not a lot of the base models are selling anymore. And so the average new car price is going up because the luxury cars are still selling, but the economy cars are not. Well, they have corrections for that in CPI. They don't look at what the average price is. They just look at what was the price of a Ford Focus then, what is it now? So that might be a little bit of an explainer for the negativity in the new vehicles section. Used cars and trucks, negative 6.6% year over year. That is that's less negative than it was last month. Last month it was negative 11 for used cars, now negative 6. And here you go. You got a 4.4% monthly increase in used vehicles. So that one was an addition to the survey. Some other important things we've got here is transportation services. That's your core non-housing services that Jerome Powell likes to talk about. Came in at negative 0.2% month over month, but still very high year over year at 11.0% for transportation services. So that's a big one. And of course, the index for shelter, which counts for almost a third of the whole CPI, still 8.1% year over year and 0.4% month over month. So the cost of the rent is still going up for the average folks. Although I should mention that for a couple of months now, we have seen a deviation. The inflation rent numbers have stayed high, even though the average rents you'll see on Redfin or on Zillow, they're coming down very quickly. Well, the government for so long understated the rate of inflation in shelter that they kind of have no choice here. They have to let those numbers come back to reality, which means the CPI print inflation numbers are going to be a little bit higher than reality because for so long they were so much less than reality, and they have to let that correct. So the shelter index remains a little bit skewed. But overall, we are looking at 4.9% headline year-over-year inflation, 0.4% month-over-month, and core inflation 5.5 year-over-year and 0.4 month-over-month. What will markets think? Well, right now, markets still like it. The Dow is up 62 points, or 0.19%. That's Dow futures, I should add. S&P futures are currently up 14 points, or 0.34%. And the NASDAQ futures are up 0.4%, or 56 points. So right now, stocks like it. Let's look over at the U.S. dollar. The DXY is currently up 18 basis points, or 101.8. So the dollar's going a little bit higher on this. This is actually predicting a slightly more aggressive Fed or a more scarce dollar. So the dollar's not telling us a lot. Also not seeing any big changes in the bond market right now. The 1 month is yielding 5.51%. That's down about 2 basis points. And the 10-year at 3.51, basically flat. So not a lot happening there. Looking over in commodities, gold is up about almost $7 at $2,049. Silver's up about 20 cents or 0.75% at back over $26 at $26.09. We've got oil is flat, down about a quarter at $73.47, and natural gas at $2.23, down about 3 cents. So market's not really reacting too much to this one. Let's see what the Fed people are saying right now, because here we go. This is what interest rate futures are predicting about the Federal Reserve's next move. So right now they're saying there's an 81% chance that the Fed does nothing at their next meeting. That is according to the CME's Fed Watch tool. Now, I took a screenshot of that right before we went live just to see if there would be any effect from this meeting. And it looks like right before we went live, we were looking at a 75% chance that the Fed does nothing. So it looks like a slightly higher chance. Now it's saying an 81% chance. So the market really, this is not a market moving event. Let's put it this way. Inflation did come down. It came down ever so slightly, just enough to give the stock market a couple of points. But this is not really changing the narrative of the Fed pause, that the Fed is done with the rate hikes. Only a small percentage of people are still saying that the Fed is going to increase rates from here. So not really, I don't want to say nothing burger, because inflation is still coming down. So you're probably going to see the politicians taking their victory lap, even though this has nothing to do with politicians. Again, folks, the saying goes, the solution to higher prices is higher prices. When you get inflation, if you just do nothing, inflation will come down because people can't afford to pay higher prices forever. Sooner or later, they start voting their wallet and changing their behavior, and it brings those prices back down to earth. Of course, try explaining that to these big government globalists, statists, central bankers, and everybody who just insists on, well, let's just cause the mother of all depressions in order to fight the inflation that we caused with our excess money printing. Not just like the thinking of a central banker. So long story short, 4.9% headline 0.4% month over month. And that's all I got from you folks. I just want to say thank you very much for watching this morning. I know it's early. Thank you to my, oh, wait. Thank you to my Patreon supporters. I also have to say thank you to you guys. And wait, I missed a super chat. I almost forgot. I am remiss. My goodness. Give me a minute to scroll through and find that super chat. Where are you, Mike? I saw you in there. I almost missed you. Here he is. Thank you, Mike Bender from Robin RC. He says, so we get a surprise or not? Roller coaster time. Well, I'm a little late with that, Mike. No, I'm going to say no surprise, really. A little bit lower, 4.9. I mean, look, you could have predicted that four handle just because the government, the politicians, the people in power want that four handle because, oh, thank God, inflation's only 4% now. See, my plan is working. You probably could have predicted that we were going to get that. So, no, Mike, I don't think that was a surprise. Market's going to get a little bit of a relief rally. I don't think it's going to matter. Right now, I think it's all about banks. I think it's all about debt ceiling. And medium term, I think it's all about commercial real estate. That is what is going to drive markets one way or another. Thank you very much, Mike. I appreciate the super chat, sir, the support of the channel. I also appreciate your support of the channel on Patreon as well. Mike is one of our OGs at the Patreon group. And thank you, Contrarian08, who says we called 2 more hikes even after SVB collapsed. QE on one hand, rate hikes on the other. It's enough to stop inflation. The Fed has lost. No. Has the Fed lost? I don't think the Fed really wins or loses here. The Fed just is. The Fed is this big, hungry, bloated behemoth that really just exists for its own purpose. Its dual mandate is a joke. All right. If their dual mandate is to maintain price stability and to maximize employment, they're failing in both because price stability is all over the place. Obviously, you've seen that with everything going on in inflation. And, among price stability, I would mention asset price stability is also a thing. I don't think stocks are supposed to rally 1,000 points up and down in single days. I don't think that's normal either. I don't think we should have housing bubbles that get so grotesquely overinflated that we have almost 1 million people in the United States living in tents. All right, so I would include the price of a home and the price of a stock and the price of bonds among those things counted in price stability. And the Fed has failed grotesquely in that area. So, no, I don't think the Fed, have they lost? I guess that's a little bit of a loaded question, all right? We lose. That's the fact that the Fed exists, we lose. Because the Fed just interferes with free market price discovery by jimmying interest rates, by changing the supply of money. They're interfering with organic price discovery, and price is nothing more than information related to the scarcity and the importance of something. And if we don't get organic price discovery, then the economy has no way of accurately handicapping just how scarce something is and how much more of it is needed. And therefore, it interferes with that solution to higher prices being higher prices. Case in point, food. When we get food shortages and food prices rise, farmers are incentivized to plant more food and grow more food, and therefore more food supply comes to market and the food shortages get alleviated. That's how price discovery works in a free market. But instead, we get the Fed comes in and says the problem, we have a food shortage. We need to print more money. All that does is send those food prices even higher. It doesn't make any more food appear. And that's just one of the ways that the Fed just interferes. So has the Fed lost? I don't know if the Fed has lost. I can just tell you we lose. The fact that the Fed exists, we lose big time. And thank you very much, Contrarian08. Oh, he's got a clarifying comment. Thank you, Contrarian. He says, they lost the fight with inflation, basically. No, I don't think they lost the fight with inflation. I do think inflation is going to come down. If they do nothing, if we just stop right now, no more changes to rates, they just continue their QE, or even if they stop doing their QT right now, if the Fed just stops doing everything, then inflation will come down and go deeply negative. There will be a massive deleveraging event if the Fed just takes no action. If they don't print or destroy, they don't raise or lower, if they just stay, then we will get massive deflation because banks will continue to fail because hundreds of banks are already insolvent. It's just a matter of time. Americans are spending down their savings, which is kind of like a bank run. When you pull money out of the bank in order to pay for your existence, that is kind of, you're slowly withdrawing your money. You're slowly running the banks. Maybe we'll call that a bank walk. So, no, I don't think they've lost. Now, I do think the Fed chose inflation with their bank term funding program, with all of the excess lending that they did, with the guaranteeing of all deposits at Silicon Valley Bank and First Republic Bank. The Fed chose more inflation when they bailed out those deposits because they lent more money into existence. And it wasn't just the Fed, it was also the Treasury and the FDIC and some of the federal home loan banks, the banks themselves. So if those bank failures had been allowed to go down according to the law, which says shareholders and depositors, uninsured depositors, get bailed in, then we would have seen a lot of money destruction and we would have seen a lot lower prices. So the Fed did choose a little bit more inflation. But right now, no, I don't think the Fed has necessarily lost the fight against inflation. But that's not a good thing because if we do get deflation, well, you could argue I don't think that's worse. It's just a different kind of pain because now you're talking people have negative equity in their homes, their 401ks, their retirements and pensions are worth less. So again, it's not a matter of Fed win, lose, we lose. That's the only answer that's the most accurate answer I can come up with. No matter what the Fed does, we lose. Just the Fed's existence is a losing proposition for the average person. Thanks very much, Contrarian08. I appreciate the support of the channel. And thank you to my Patreon supporters once again. Looking forward to talking to you guys at 5 p.m. tonight for our weekly Zoom call. That's 5 p.m. Eastern time, by the way. Link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.